Hey guys, welcome to my channel Money Invest. One of the greatest investors of all time is Peter Lynch. Peter Lynch served as the fund manager of the Fidelity Magellan Fund for 13 years, overseeing a rise in assets from $20 million to $13 billion. For 13 years, the fund returned an average of 29% each year under his leadership. Investing $10,000 in Magellan Fund when Lynch was in charge would have resulted in a gain of $280,000 in 13 years. PEG was also introduced by Mr. Lynch. It's important to keep growth in mind when using the PEG ratio to determine whether a stock is a good value. Divide the company's PE ratio by its historical growth rate to get the PEG ratio. According to Mr. Lynch, the greater the PE ratio, the more you should pay for a company that is quickly growing. Some of Lynch's crazy tips, all of which can help you build long-term wealth for new investors. Before we go any further, please subscribe to our channel and click the notification bell to receive updates on future videos like this. So without further ado, let me introduce to you how to invest for beginners. Do your homework before investing in a firm. Stocks and corporations with weak balance sheets have suffered the most losses. Before putting your money in danger, check a company's balance sheet to make sure it's solvent. Everyone is capable of making money in the stock market. Having the guts to do so isn't a given for everyone. Stocks and stock mutual funds should be avoided if you're prone to panic selling. You don't receive a Wall Street expert's edge as an investor. It's a resource you already possess. It is possible to outperform the experts if you exploit your advantage by investing in companies or industries that you are familiar with. The stock market has become dominated by a herd of professional investors over the past 3 decades. This, contrary to popular assumptions, makes it easier for novice investors to get involved in the stock market. You can outperform the market if you don't follow the crowd. For a few months or even years, there is often little correlation between the performance of a company's operations and the performance of its stock. The stock price rises in tandem with the company's performance over the long run. Be patient and invest in successful businesses. This disparity is what makes money. Don't take on more than you can handle when it comes to stock ownership. A part-time stock picker likely has enough time to keep tabs on 8 to 12 businesses and purchase and sell shares as the situation dictates. The portfolio doesn't need to contain more than 5 companies at any given moment. If you're unable to locate any business that piques your interest, you should reserve your funds in a bank account until you do. Do your homework before investing in a firm. Stocks and corporations with weak balance sheets have suffered the most losses. Stocks in booming corporations should be avoided. In industries where there's little or no growth, the best companies consistently win large. You should wait until a tiny company has made a profit before investing in it. Investing $1,000 in stocks allows you to gain $10,000 or even $50,000 if you're patient enough. Few good stocks are enough to make an investor's life worthwhile. Every industry and every region has tremendous growth, companies that amateur investors can locate long before the professionals do. In Colorado, a January snowfall is as common as a stock market drop. It won't hurt you if you're prepared. Investors fleeing the storm in fear often sell their holdings as a discount during a collapse. For the most part, you'll always have something to fear. Keep your mind off the weekend and don't listen to the latest doomsday forecasts from the news. If the fundamentals of a company are deteriorating, then sell the stock, not because the sky is falling. Interest rates, the economy's future path, and the stock market's direction are all beyond the control of anyone. Ignore all predictions of this nature and instead pay attention to the performance of the companies in which you've made investments. There is a company out there for which the story is better than expected. If you study 10 of them, for every 50 there are 5. A pleasant surprise can be found in the stock market, a company that Wall Street has missed. In a poker game, if you bet without looking at your cards, you have the same probability of winning as if you studied your cards. Peter Lynch's smart tips on how to invest. First, invest in what you've already learned. Though this is one of Lynch's most famous quotations, there is a common misunderstanding of its meaning. In other words, just because a firm makes your favorite product or service doesn't mean you should invest in it. Before purchasing stock in a company, investors should thoroughly research the company's competitive position, financials, and growth prospects. According to Lynch, the phrase "buy what you know" means that you should stick to what you know and invest in areas you're familiar with. Focus on the businesses, not the stocks, is one of the keys to successful investments. Stocks are more than just a bunch of numbers on a piece of paper. Partial ownership of genuine firms is represented by these tokens. Because of this, the value of the company's stock is ultimately determined by its basic drivers: sales, profitability, and cash flows. It doesn't matter what the stock market performs today, tomorrow, or even next week. It's important to remember that risk and uncertainty are two separate things for long-term investors. The daily fluctuations of a stock's price are meaningless. A preferable strategy for long-term investors would be to focus on reducing risk, which is defined as the possibility of irreversible loss of capital. Focus on quarterly and even annual operations, and financial performance would be more useful in this regard compared to the superficial glance at often misleading headlines daily. It takes 3 or 10 years for the usual large winner to play out. It's difficult to hang onto your investments when you're afraid. Even the most devoted bulls can be swayed by spooky headlines and fear-mongering pundits. As a result, knowing why you own your assets is critical. When the basic story of a firm hasn't altered, you can stand by your stocks, as Lynch puts it. When you own stock in a high-quality company, time is on your side. It's possible to get a significant advantage in the marketplace by investing in high-quality enterprises. It's not uncommon for companies with substantial advantages to get stronger as their weaker rivals fade away from time. In addition, exceptional enterprises can create enormous profits for decades, allowing you to compound your winnings over many years. When investors try to prepare for or predict corrections, they lose far more money than corrections themselves. There's no need to attempt and time the market cycles if you own stocks in high-quality companies. When a recession is imminent, it's practically hard to predict. Getting back in at the bottom is also quite difficult since things tend to look the most gloomy. To get the most out of the stock market, simply holding on to your investments is preferable. That way you'll be ready to reap the rewards when the market recovers, as it has done time and time again. As an investor, you don't have to be perfect. The asymmetric risk profile of equities is part of their allure, even while a company could lose 100% of its value. The best stocks can grow 1,000% or more in the long run. A few big winners can therefore more than compensate for your losers. If you have a few huge winners in your portfolio, the benefits of those investments will far outweigh the drawbacks of investing in stocks that don't pan out. You can change your life with one amazing investment, and a few multi-baggers can provide you with all the money you need. There comes a point in your life where you must decide whether to become a slave to your net worth by spending the rest of your life building it, or whether you can let what you've accumulated begin to serve you. And that's it for today, guys. I hope you enjoyed this video, and if you did, kindly let us know in the comment section. Don't forget to like this video, subscribe to our channel, and smash that notification bell so you don't miss out on any fantastic content like this from us. Thanks for watching. Until next time.